Yesterday, while every screen in America flashed the same three words, inflation is cooling, a company that's been around for over 100 years quietly lost $67 billion of its value in a single day. IBM, down 25%, its worst day in nearly 40 years. And almost nobody said it next to the other number that printed the same week. The $49 billion in profit the biggest banks on Wall Street just booked in 3 months. Those aren't two stories, they're one story. And it's the same one I laid out for you on Thursday, when I told you the Fed was getting ready to hand the banks exactly what the banks want. Today it started. So let me do what we do here, line the dominoes up, and knock them over one at a time. Because when you see them fall in order, they don't point at a bad quarter for one old tech company. They point at a credit machine that makes 2008 look small, and at the one place money always runs when that machine seizes. I even built a way to watch these exact dominoes so you're not caught flat-footed. I'll come back to it. Stay with me. This one lands right on your savings. Start with who's winning, because that always tells you the most. This week, 5 of the biggest banks in America reported earnings, and together they pulled in $49 billion of profit in a single quarter. JPMorgan alone made $21 billion. But here's the part that matters, and the part the headline skipped. That money didn't come from lending you a mortgage. It came from trading. JPMorgan's stock trading revenue jumped 86% in 1 year to $6 billion in 3 months. Goldman Sachs posted the best quarter in its entire history. So ask the question nobody on TV asked. What have they been trading? What's the trade that's been going straight up all year, minting record profits for the trading desks? The AI trade, the chip stocks, the cloud stocks, the handful of names that have carried this entire market. The banks have been riding that wave, and this quarter, the wave paid them $49 billion. Now hold that thought, because a machine that only works when one trade keeps going up has a very specific weakness. It needs that trade to keep going up. And this week, for the first time, it stopped. Before we get to what cracked, look at the cover story, because the timing is almost too clean. Yesterday's inflation report came in at 3.5%, down from 4.2. Every anchor read it as a win. But open the report, and one line did nearly all the work. Gasoline fell almost 10% in a single month. Strip energy out, and consumer prices didn't cool at all. This wasn't the whole economy calming down. It was one volatile price, oil, dropping at exactly the right moment. Here's why that timing matters. A cooler inflation number is the permission slip. It's the thing the Federal Reserve needs to point at to justify cutting interest rates. And a rate cut is precisely what the banks and the AI trade need to keep the party going. Cheaper money, more borrowing, higher stock prices, another record quarter for the trading desks. Think of it like a referee who needs an excuse to make the call he already wanted to make. Oil just handed him the excuse. The gas pump gave the Fed its permission slip. And your savings don't get to shop at yesterday's gas price for the next 12 months. You just get the rate cut and the consequences. Which brings us to the man holding the whistle. The new Fed Chair, Kevin Warsh, is sitting in front of the Senate Banking Committee as this video goes up. Second day of testimony. And here's what he did yesterday. When they pressed him on whether a rate cut is coming, he didn't say yes, but he pointedly refused to say no. He called the inflation improvement, quote, not mission accomplished, and left the door wide open. That's not indecision. That's a man keeping the option alive. The banks reported record trading profits on Monday and Tuesday. The inflation number gave him cover on Tuesday. And on Wednesday, he's in the Senate refusing to take the cut off the table. Read the sequence, not the speeches. Everything so far is the setup. Banks flush, oil conveniently down, the Fed leaving the door open to feed them more. That's the boom half. Now watch the first thing fall. Here's where the floor gives. The same 48 hours, all of that good news printed, IBM cratered 25%, $67 billion in market value. Gone. And the reason matters more than the number. IBM didn't miss because of one bad product. It warned that its customers are pulling back their technology budgets. The companies that were supposed to be spending endlessly on this AI build-out just started closing the wallet. And IBM didn't fall alone. Its warning dragged the whole technology sector down with it. One old, boring blue chip company said, "Our clients are spending less," and the market flinched across every AI name. Now, I want to be careful and precise here, because this is where a sloppy version of this story falls apart. IBM is not a subprime mortgage. It's not some toxic loan blowing up. IBM is the canary in the coal mine. The first sign that the one trade holding this entire market up, the trade printing those bank profits, is running out of buyers. The canary doesn't cause the collapse. It just stops singing first. IBM stopped singing this week, and it did it on the same day everyone was celebrating cheaper gas. So what's actually in the mine? That's the part they really don't want you looking at. And it's the part that decides what happens to your money. Here's the engine under the AI boom. Once you understand how it's wired, the danger is hard to miss, and it's the exact part they'd rather you didn't look at. The biggest names in AI are, to a stunning degree, funding each other. Nvidia put something like $100 billion into OpenAI. OpenAI turns around and commits hundreds of billions to cloud companies like Oracle and Microsoft. And those cloud companies use that money to buy Nvidia's chips. The same dollars go around in a circle, and at every stop, somebody books them as revenue. Picture three business owners at a table with a single $100 bill. The first pays the second for services. The second pays the third. The third pays the first. Pass that one bill around the table 3 times, and all three can report $300 of income off $100 that never left the table. That's not fraud, exactly. But when the same 100 billion shows up as a chipmaker's sales, a startup's funding, and a cloud company's backlog all at once, the headline numbers stop meaning what you think they mean. And here's the part that turns a stock story into a credit story. The part that should get every saver's attention. A lot of the money building the actual data centers isn't coming from these companies' own cash. It's borrowed. And increasingly, it's borrowed in the shadows, from private credit, the giant, lightly watched pool of lending that sits outside the regulated banks. Right now, roughly $120 billion of this AI build-out is being financed off the balance sheet, kept in the drawer, where it doesn't show up cleanly when you look at what these companies actually owe. If that gives you a familiar, uneasy feeling, it should. Because we've seen off-the-books borrowing pile up in a corner of the market that everyone swore was safe. Last time, it was houses. This time, it's data centers. And this time, the loans are hiding in an even darker corner. This isn't a prediction. It's already started. One of the biggest private credit lenders, Blue Owl, just tried to raise $4 billion to finance a data center for a company called CoreWeave, one of the poster children of the AI build-out. And it couldn't get it done. The outside money looked at the deal, looked at CoreWeave's junk-level credit rating, and said, in as many words, "We saw it, we passed." Sit with that. At the absolute peak of AI euphoria, with everyone swearing this is the biggest thing since electricity, the smart lenders wouldn't fund a $4 billion piece of it. That is the exact sound the mortgage market made in 2007. Not a crash, just deals that suddenly couldn't get financed. Meanwhile, the regulators are watching Wall Street quietly slice up its AI data center loans and mail the risk off to someone else. The same risk shuffling trick that blew up last time. The private credit industry sold itself for years as the place where nobody ever loses money. That story is ending right now, with defaults rising and investors trying to pull their cash out. IBM was the canary. This is the gas leak. This is exactly why I built the Macro Command Center at timtalksfinance.com/members. I don't sit and refresh these numbers all day. On the full package, it emails me the moment one of these signals moves. A failed financing like that CoreWeave deal, a jump in credit stress. And the free account, no credit card, puts the same live macro numbers I'm watching right now on your screen. More on that at the end. For now, let me connect this to the only thing that matters, which is what it does to you and where it sends your money. Here's the through line. Every single thing holding this market up depends on somebody's willingness to keep extending credit. The AI companies depend on the circle of financing. The data centers depend on private lenders. The bank's record profits depend on the trade staying up. The stock market depends on the rate cut. And the rate cut depends on the Fed. Every prop in that chain has a human being, a lender, a committee, a chairman who can pull it. And when confidence cracks in a machine built on borrowed money, it doesn't unwind slowly, it seizes. Lenders stop lending all at once. Everyone reaches for cash at the same moment. And in a scramble for dollars, people sell whatever they can, not just what they should. Good assets get thrown overboard right next to the bad ones. That's a dollar shortage. And here's the honest, uncomfortable part. Because I will not sell you a fairy tale. In the first phase of a dollar shortage, Bitcoin falls too. It happened in March of 2020. When the whole world grabbed for cash, Bitcoin got cut roughly in half in a matter of days, down toward $3,800. So if you're expecting Bitcoin to save you in week one of a credit crunch, it won't. It gets sold with everything else. But watch what happens next. Because the next part is the whole ballgame. When the credit machine seized in 2008, the Federal Reserve turned the printer on and bought mortgage bonds to refill the system. In 2020, they did it again. This time, the drain they'll print into won't be housing. It'll be the government's own debt, sold to prop up an AI economy that Washington has already decided is essential to national security and can't be allowed to fail. Same move as 2008 and 2020. Bigger button. Because the bubble is bigger, the liquidity that comes to rescue it has to be bigger too. And that flood of new dollars has to go somewhere. Follow it. In 2020, Bitcoin fell to 3,800 in the panic. And then, as the printer roared, it ran to 69,000. The crash came first. The repricing came second. That is the pattern. And the setup today is the same movie on a much bigger screen. And here's why it lands on Bitcoin and not on anything else. Every asset in this whole story can be created more of. They can print more dollars. The Treasury can issue more debt. The AI companies can raise more money and print more shares. The private lenders can extend more credit. Every single prop can be diluted by the person holding it. There are exactly 21 million Bitcoin. There will only ever be 21 million. No chairman can vote to make more. No lender can conjure it. No circle of companies can inflate it. It has no issuer. In a world about to be rescued by the biggest wave of printed money in history, Bitcoin is the one container that can't be refilled. Now, no certainties here, only probabilities. That's the honest way to hold this. I'm not telling you Bitcoin can't drop. I just told you it probably drops first. I'm telling you that when the response to a credit crisis is always more printed money, the one asset with a fixed supply is where that money goes looking for a home. You don't have to bet the house on it. You just have to understand the direction and why the direction exists. So where does this go? Two roads. No false certainty. Road 1, the slow version. The Fed cuts, the cheap money papers over the cracks for a few more months, the AI trade limps higher, and the reckoning gets pushed down the calendar, while the pile of hidden data center debt keeps growing underneath it. Road 2, the fast version. The credit stops the way it stopped for that $4 billion CoreWeave deal, but everywhere at once. A private credit fund freezes withdrawals, the dollar scramble begins, everything sells off, Bitcoin included, and then the printer comes on harder than 2008, and the repricing begins. You don't get to pick the road, but you can watch for the turn. 3 signals, specific and checkable. Signal 1, watch Warsh. The moment the Fed stops hinting and actually cuts, the permission slip has been cashed. Signal 2, Watch private credit, one more failed financing like Blue Owls, or a fund that halts redemptions, and the crunch is here, not coming. Signal 3. Watch the AI names themselves. If more of them start warning that customers are cutting budgets, IBM wasn't the canary, it was the first of many. Here's the one line to carry out of this. The banks got their record quarter, the Fed is lining up their rate cut, and the whole thing is standing on borrowed money hidden in a drawer. When that drawer gets opened, the rescue always looks the same. More printing, and the money always ends up hunting for the one thing they can't print more of. That's Bitcoin. 21 million. Fixed. Forever. So start free and set your own watch. No credit card, 2 minutes. Take the money quiz at timtalksfinance.com/members, and it'll show you in real dollars what a printing-fueled repricing would do to your savings. Plus one move worth considering for your situation. The live signals I've been walking you through are right there on the free account. The automatic alert that emails you when one of them moves is on the full package, the same one I use. Either way, you're not watching these dominoes fall alone, because they are going to fall. The only question is whether your savings are sitting in something they can print their way out of, or in the one thing they can't. I'll see you in the next one.